Alright, let's get the introductions out of the way. My name is RGM, and a warm welcome to you to the Z Stack series. Before I start, I just want to say I'm not a financial advisor, I'm not a guru, I'm not trying to sell you something for my own benefit. I'm not trying to cause some pyramid scheme here. I'm here to just lay down some facts. I'm not that chess player who says knight to d7, pawn to a2. No, none of that. What I'm here to help you with is help you enable your own hustle toolkit, your side hustle toolkit. I'm gonna basically explain to you why 90% of you retail traders are losing money, only 10% are profitable, who's making the money, why it's like that, and together we can help you rise above it. And stay tuned for what's about to come. So this is just a start. I'm guessing that most of you who know me, and delighted for those of you who will get to know me as time goes by. I'm changing shirt colors from white to dark blue. Just think of it as bullish and bearish candlesticks. My Instagram page, where I have uploaded a couple of reels, very macro oriented stuff. Don't worry, that stuff will continue. In this video, I'm not gonna get into an in-depth macro discussion, but there will be content that follows in due time. So, in the description, I have put my Medium page link, and this Medium page will sort of serve as the backbone where we keep you updated as to what we're building on this, platform. Everything that I'm referencing in this video would be from the Medium page, and any links, any updates, it's sort of like the blog that maintains the continuity here. So before I start, I'm not a financial advisor, let's get that established, but every opinion in the market does carry significant weight. And part one of this iHustle series is about trading and investing, so there's a lot more on the horizon. No spoilers today. I think everybody should trade and invest. Nobody sees the work that you put in, and there's such a risk in the rolling out of the final product. I think it's essential to maintain a momentum. It's good for your mental health. It's good to have an income stream besides stock dividends, besides your job, besides crypto staking, besides, bond coupons. So this is not a one size fits all approach, nor is it an all size fits one approach. I'm not here to help you find hay in the haystack. I'm trying to make you find your golden needle in the haystack, which you alone are capable of. So, what I've done here to sort of set the direction and to set the foundation to build upon this series and this hustle toolkit, I've put a survey. I put the link in the description, and it is a way for you at large to interact with me and tailor my content in a way that addresses your needs and addresses you as the demographic and community at large. So my Instagram page is in the handle as follows. See, one thing I'm hoping to accomplish is that at the moment, you're probably reading the news, you're probably seeing these interviews on Bloomberg or CNBC or whatever, and these journalists are asking reputed, CIOs, senior analysts, mega investors, where they see the markets going from here, where they see commodities, gold, I don't know, orange juice, coffee, something like that. And that's a very short-sighted approach, just to sort of bank on a credible opinion. I'm not saying it's entirely flawed, but I hope we can set your structure. You have to do it yourself, but I am helping you discover those tools, because there's always these extenuating circumstances, like the Barings Bank debacle, or in India you have the Harshad Mehta insider trading case, or the Tottenham Hotspur boss giving tips to his pilots. So you really have to be aware of things like this. This image is a value chain, or you can call it the supply chain of the industry. The entire thing is, infrastructure. Let's call it infrastructure. Let's call it the infrastructure of the inversion narrative. What it basically represents is the fact that smart money requires dumb money to exist. And yes, unless it was already implied, I'll tell you now. This infrastructure is not built for you, it is actually proactively built against you. What is this video and what is it not? Okay, firstly, just condition your expectations. This is not a tutorial in any way, shape, or form. I'm not gonna teach you how to trade like the nitty-gritty of different asset classes like options and REITs, etc. Obviously, I will be making reference to options in future videos and future content because I think options are one of the most important things in trading, and I believe the potential is very vast, but today is sort of not the day for that. So one very popular derivative where you've seen a majority of UK, US, European based investors, even it's exploding in India at this point, is what we call a contract for difference. A CFD is an unregulated sort of tracker. I'll give you an example. For example, let's take the S&P 500. Let's look for the CFD. So here we have most of these are usually CFDs. Basically, you can't buy the index outright unless you get involved in futures, which is highly leveraged. But let's take this. This is an S&P 500 CFD. Contracts for difference were banned in the United States in 2013 because traders were having this trading frenzy. There was a lot of accounting genocide in the dumb money part of the ecosystem. So a contract for difference, what is a contract for difference? It is basically an agreement between you and your broker to settle a price difference from when you open the position to when you close the position. Obviously, your broker takes the opposite side of whatever trade that it is you're doing. So most retail traders don't realize the margins of benefit of investing tactically and logically. Some of them probably just buy and sell options as proxies to go long and short on something, maybe a commodity future, a single equity name, or an index thereof. So maybe in the spur of the moment, she believes that she'll make some £100, dollars, rupees. On the other hand, options are a bit more complex than that. I'm not diving into options right now, but so say that she sold a call option one night before company's earnings, thinking that company's gonna go down or company's gonna wind up. The next day, or the night before, earnings come in better than expected, and this is after the market closes. The next day, she is bankrupt. So this is your dumb money. On the other hand, you have smart money, which is your hedge funds, pension funds, investment banks. So these players transact directly with exchanges, and they provide these investment banks provide a credit clearing facility for these retail brokers. So now my hope is that you're picking up on this negative feedback loop that's peddled from these investment banks to the retail brokers, to the trading educators, and then to you, the retail traders. So the brokers, right, they make their money from spread, commission, OTC gain, and financing tone. The financing tone is basically the money that these brokers made. That is the percentage difference in what they borrow from creditors in order for their clients to use as margin, collateral funds, and the sort of charge they levy on clients for borrowing those funds. So those funds are used to finance your margin trades, and and this is where a credit clearing facility is as well. So you see, where the matrix of control sort of trickles down here. The two buckets of liquidity. You have the A book and the B book, two different kind of clients. So these two clients, they're using these retail platforms because that's the only source of liquidity. That is the interface, that is the software. So the A book is 90% of retail traders who, aka losing clients, they just do what they're told from the trading educators, and your retail brokers take the opposite side of whatever trade it is that the retail traders execute. Your broker will make money from the OTC loss that you incur. So basically no dealers are involved in these OTC trades, and your broker basically makes the spread. He makes the commission, the OTC loss, and the financing tone, of course. And these A-book clients are unhedged. They just open naked OTC positions, and you'll find that the losing retail trader starts to unwind. Therefore, the broker starts to auto unwind the position. Your B-book clients are the ones who irritate the brokers. 10% of winning clients. They have hedged their bets, and so the broker incurs the OTC loss. They still make the spread, they still make the commission. So if you had to choose, it's a rhetorical question, A being the A book or the B book. If you look at the link in the description, I've actually recommended a few books which I absolutely advise that you read. It will really help you achieve alpha trading status, and it will really be stimulating, and it will help you achieve your goals. If you click on the links in the description, you will get them at an optimal price. The next steps are follow the Instagram page, follow the Medium page, join the mailing list, and we move from there. I will be creating a Discord pretty soon, and I will be making announcements, so if you want to stay up to date, find me there. This is the kind of stuff you can expect in the future. Focusing on the routine. Okay, so now start adding points in that same time period, 7:38, whatever you want to call it. The planning should be done ideally before the market opens. We can now set option strategy based. So for example, these 3 minute trades,